Well, once again, October has rolled around once more, and undoubtedly the financial media will be full of sage pieces of advice as to what everyone should be doing as this month supposedly exerts its magical influence upon markets. I thought, however, I would look at something different. I've spoken and written at length as to the nonsense that is associated with October and its historical context. I thought I would look at what happens to markets as they actually begin to unravel, what structural changes occur, and what things become apparent. Because as we will see, history does have a tendency to repeat itself, and it repeats itself because behaviour repeats itself. One of the things about having been around for so long is that I've gotten to observe and participate in all of these little market hiccups that have come and gone over the past given number of decades. One of the things that always surprises me, though, when people talk about market crashes is the presumption of how they unfold. The presumption is that what happens is you go to bed on a Friday, you wake up on a Monday, and magically the market is halved without any warning, without any hint that this may have occurred or be in the process of occurring. So people have this perception that markets just magically nosedive straight into the ground from an all-time high, and that catches everybody by surprise. That has not been my experience over the past God knows how long. My experience is that markets tell you what they're going to do. And again, we come back to that fact that I keep harping on about, that all you have to do is listen. But the problem is most people don't listen. The only time I have seen, and I hesitate to use the term market, completely plough itself into the ground was in 2015, when it was decided by the Swiss equivalent of our Reserve Bank that they would unpeg the Swiss franc from other currencies. They made this decision and announcement seconds before the market opened. And this caused an absolutely cataclysmic collapse in that pair and all other associated Swiss franc pairs. And this is the daily chart of when that occurred. The period before the actual crash looks strange, not because there was any unusual market activity, but because what's happening is the charting program is attempting to compensate in terms of scaling for the magnitude of this particular fall. And so that's why it's bunched up those bars and why all bars post that date look relatively normal. And this is a daily chart, but it doesn't actually tell the entire story. If we look at what occurred on an intraday chart, this is a 1 minute chart, you can see a completely different story emerges. You have this enormous gap. Gapping in FX markets over this time frame is very, very unusual. And it's very, very unusual because of the incredible liquidity of FX markets. And you can see now why this sort of move caused losses in the order of billions of dollars for retail investors, not professional investors, retail investors. Many people awoke to see that their account actually had a negative balance, and that it was often quoted at the time that that negative balance was larger than the value of the house they actually owned. But, and this is a big but, this is what's known as a specific event. This is an event that was dialed into a given segment of the market, of a particular market, and a very narrow segment at that. So this was not a market-wide event. So my expectation is that you would not see that sort of move in an index. where you have an announcement just before the market opens and the market completely collapses. When we look at risk in markets, there's two very generic sorts. There's market risk and specific risk. Market risk is simply the risk you take on by being involved in a market that is made up of potentially tens of thousands of instruments. A specific risk or specific event looks at risk as it applies to individual entities. And you can see this when we look at equities. And I've dug back a little bit in time, so this is a little bit of a history lesson as well. This is HIH, a locally listed company that unravelled around 2000. And it's here that I want to start this notion that you get warning and you get repeating patterns. You can see with HIH from 1995 there's a multi-year uptrend. Price then peaks, trying to punch through 380 towards $4. It fails. Price has a reaction low that it bounces off, attempts to recover and fails. It has another reaction low, attempts to bounce off that and fails again. Price then continues to collapse and collapse beyond that reaction low. Now granted, in hindsight, everything looks perfect. But think of the picture you're being given here. You have an uptrend that has failed. You've had 3 attempts to move back into uptrend. You've then got price collapsing down into a downtrend. Granted, nobody knew that HIH was unravelling at the time, but even as an equity trader, if you were still in from that 1995 uptrend, as the market began to fall, you've made a mistake. And you've made a mistake because price is telling you something. It's telling you to leave. Now, if we walk through a hypothetical, let's assume that you had bought near this all-time high, let's say 370. If you exited at 240, that's still better than hanging on to the stock, waiting for it to get better, and then having it delisted out from under you. And this sort of warning, this sort of pattern is universal. This is Enron. If you don't know what Enron was, then you're falling behind in your history of the market's homework. Go and find out. You can see a similar pattern. You see the uptrend which fails, retracement back towards the uptrend which fails, establishes a downtrend, price breaks through that reaction low, and then over the next quarter completely gives up. There was, as a trend follower, no excuse to be holding this stock as it collapsed. But as I said, these are specific events. These relate to individual entities. What I want to look at is the notion of what actually happens in the period up to a crash. And initially the one I want to look at, because we're heading towards October, is October 87. And I want to look at the Dow, where the Dow dropped 22.61%. One of the things that catches people, and which they sometimes want to argue with me about, is the notion that the market peaked before the crash. The Dow peaked in August. You had 2 months of the market beginning to become unstable and starting to drift down. Notice it did not crash from its peak. It fell from a new low that it had established post that time. And you can see that attempt to recover here. So you're being told something very important. Markets attempt to make a new high, has been in a bull market for 4 and a bit years, has failed to do so. Now granted, there was a period, let's say 6 months before, where it did the same thing, but we can see a difference. And the difference is this: price breaks through that low. Now, if that didn't convince you that it was time to leave, in some way, shape or form, or to take some sort of action, then surely the next 2 days would have. That they would have told you the story that coming into the weekend you wanted to be out of the market because they were very, very powerful down days. This leads me to a very key point. There is always time to get out, and this is the point that people miss. The assumption is, as I said earlier, market closes on Friday, opens at Monday at 50% of its value, and you have no time to get out. That's not what happens. You're given a chance to exit the market. You just have to take that chance. What is interesting, though, about the Dow is not necessarily the size of the drawdown that occurred in 87, but the fact that it really only took 2.5 years for the market to challenge that previous high. The US market recovered very, very quickly. Now, this move is many decades old. Let's come forward in history and look at the local market, the S&P 200, well, the ASX S&P 200. And this is the timing of the GFC. Notice something. Here's our high. Here's our failure to get back beyond that high. Here's a third failure to get back beyond that high. Here is our collapse through these reaction lows. So the market has given up support. And unfortunately, when you're presented with scenarios like this, there are always people who don't listen. There are always those who believe that markets get better. Now, in some way, shape or form, there is a little bit of truth in that statement, but it needs to be qualified. The index, as represented by the stocks in the index at that time, eventually over time gets better. That doesn't mean your stock will get better. Granted, if you were holding an exchange-traded fund through this and you wanted to guts it out, you could. There's a problem with that, though. The local market took, we're now looking at 13 years to get back beyond that previous high. So this notion that it will always recover is in broad generalities true, provided you're holding something that represents the index and providing you're willing to give up more than a decade simply sitting on your hands waiting. But the question arises, what happens in individual stocks as markets begin to unfold? This is CBA, darling of investors everywhere. And this is the period of the market unfolding during the GFC. You will notice CBA peaks before the unfolding. We have another attempt to take out that high. We have a third attempt. So we built this consolidation high at around about 62, 62 and a half. You're being told at the time price won't go beyond this point at this time. And it's a matter of what you do with that information. You then have this same scenario again. So you have a pattern that is very, very familiar because this is the pattern that the Dow displayed in 87. It's the broad pattern that the ASX 200 has displayed. And now it's being replicated as we apply granularity to the investigation to individual shares. And you can see there's the reaction low, price breaks through. You've been told the story, and if you needed any more confirmation as to what the story was, price then gaps down. Gapping in investment grade stocks in a downward direction is a very, very disconcerting thing. And it's something that should be paid special attention. So if you're still in at this point, then you really only have yourself to blame. But this is a daily chart, and people who hold these sorts of stocks tend to do so as part of an investment portfolio, which means it's a longer term investment. So what I've done here is I've switched the data out to weekly. So it's not daily. This is why it looks a little bit cleaner. That's why when you see the extreme right-hand side of the chart, the gap has disappeared. The way the data is assembled means that the gap is filled simply by having weekly data. But let's assume you're an investment grade investor and your entry signal is this breach of this consolidation band we have here. And what I've done is I placed simple 3.5 ATR stop that transitions out to a wider stop underneath price. The exit for this is a hard close below the ATR line. And you'll see we get touches, but not a close below. But we do get a close below, it's just below 52. That's our trigger to leave. And you might think that the stop has not worked because, well, price peaked at nearly 63, we're out at below 52. We've given up all of that. But the issue is not what you've given up in terms of potential profit, what you've saved yourself in terms of potential losses. Because if you're out at the very low 50s, you've avoided having that position halve again. And this is the central issue. Markets replicate their behaviour and over again. They have to because they're made up of people. And people display the same behaviour over and over again. That's why these charts look similar. If you look at charts of when markets unfold, they look similar. And they have to look similar because of the way people behave. So in terms of a summary lesson, markets by and large peak before they crash. So you get a warning. So in terms of structural occurrences, you will see what is happening. You won't have one of these magical events where you wake up one morning and you're broke. As a general point, price fails to take out the last high, and it may fail as we've seen several times. In a bull market, if price is failing to take out previous highs, then that's telling you something. Price is either entering congestion and going sideways, which is what happens a lot of the time, or price is reversing. Part of the reason why people cannot accept prices reversing is simply ego defensiveness. They do not want to admit that they perceive in themselves to have made a mistake. They perceive that any investment they buy should go up forever. Unfortunately, that's not the world works. So the market is telling you something. It's telling you to leave. But this decision to leave is made so much easier if you let stops do the hard work. Let the technology take care of the emotion of the events that are occurring around you. So whilst everyone else is running around like a chicken with their head cut off, you've allowed the technology to do the work. And this brings me to my final point, which in turn, in some ways is based upon the fact that our local market took so long to recover. When markets unravel and they come apart, there is often the temptation to try and get in early and get involved. There are always people who want to try and hit the bottom of the market, get the lowest prices they possibly can. My advice on that perspective is simple. There is an old parable that simply says, pioneers are the ones with arrows in their back. Step out and go do something else. Let somebody else be a hero, and you re-enter when the time is right for you.